In the stock market, one strategy stands out for its ability to turn volatility into opportunity. Hi, and welcome to my channel, where I unlock the secrets of earning income from the stock market. My name is Orford, author of The Financially Independent Millennial, and today I'll be your guide helping you select put options to sell. In this video, we're going to dive into a strategy that has not only stood the test of time, but has let investors generate consistent weekly or monthly income regardless of market conditions. Selling put options is a method I've been using since 1996, not just to survive, but thrive in the market. And today, I write and produce content about generating income through stocks and options, and the largest platforms like Yahoo Finance, Nasdaq, and Business Insider all trust me enough to publish my work. But here's a quick disclaimer. While I'm passionate about sharing what I've learned through years of trading, I'm not a licensed financial or investment advisor. Think of this video kind of like a conversation with a friend who's been, trading stocks and options on his own and talking about what he knows to you. And whether you're new to the channel or a returning viewer, I'm excited to share that today's video is packed with information. We're breaking down the basics, talking about the benefits, and of course, I'm going to guide you through all of the strategies that have helped me and can help you make a bunch of money along the way. So if you're ready to learn how to select put options to sell, navigate through market volatility, and potentially earn some decent money doing it, you're in the right place. And of course, don't forget to hit that subscribe button and the bell. That way you won't miss any future part of this series. Okay, so let's get started. All right, so let's kick things off by explaining what put options are. Picture this. You're eyeing a stock, confident it's going to climb. But you also see an opportunity to make some money, even if you're just a tad wrong about the timing. And this is where selling put options comes into play. It's kind of like offering an insurance policy to other traders. A put option is a contract that gives the buyer the right, but not the obligation, to sell a stock at a predetermined price. That's the strike price within a certain period. Now, if you're selling that option, you're the one who's offering this right to the buyer. And for that privilege, you get to collect what's called a premium. So why would you do this? Well, there's actually two reasons: income and buying stocks at a discount. First, the premium that you collect is yours to keep, regardless of whether the option is exercised. It's a way to generate income on stocks that you're interested in, almost like getting paid to wait for the stock to drop to your desired buy price. And that leads to the second benefit: acquiring stocks at a bargain. By selling a put, you're saying, I'd love to buy this stock, but at a lower price. If the stock dips below the strike price, you might get assigned the shares, essentially buying them at the discount you wanted, plus you get to keep the premium. And then you can brag to your friends that you got paid to buy a stock. But here's the beauty of it. If the stock stays above the strike price, you just pocket the premium without buying the stock. It becomes a win-win situation if you play your cards right. And in today's market, where volatility can be as unpredictable as the weather, selling put options can be a strategic move to increase your investment income. Now, I know what you might be thinking. Rick, is this too good to be true? Well, like any investment strategy, there are risks. And we're going to look at those a little later. But with the right approach and knowledge, selling put options can be a powerful tool in your investment arsenal. Before we move on, I'm curious, have any of you sold put options before, or is this a new concept for you? Drop your experiences or your questions in the comments below because I love hearing from you and I'm here to clarify any doubts that you might have. And stay tuned because next we're going to break down how to select put options that can lead to profitable trades. It's all about choosing wisely, and I've got some tips and tricks that's up my sleeve that you really won't want to miss. All right, so now that we've got the basics down, let's look at the art of selecting the right put options to sell. This isn't about throwing darts at the board or dice on a craps table. It's about making informed decisions that align with your investment goals. First up, let's talk about what's called implied volatility. Volatility is like the pulse of the options market. High volatility means the stock price moves a lot, and this can lead to higher premiums for the options you sell. But remember, with high potential returns comes high risks. Next, consider the strike price. This is the price at which you're agreeing to buy the stock if it's put to you. A rule of thumb: you'll want to sell a put option with a strike price that's below the current stock price, but not so low that the premium doesn't make the risk worthwhile, right? So this is kind of like a balancing act. And don't forget about the expiration date. Options are time-sensitive contracts, and generally, shorter expirations mean higher annualized returns on the premium, given the less time for the stock to move against you. But there's less time to be right on your trade as well. Now, longer expirations give you more time, but they usually lead to lower annualized return. So let's actually pick a put option to sell. So which stock do you pick? Well, start with stocks that you're bullish on in the long term. Why? Because if you end up owning the stock, it should be one that you're happy to hold. Look at trends, earning reports, and other indicators to gauge where the stock may be headed. Also, when it comes to selecting put options to sell, remember, our goal is for them to expire unassigned. And what do I mean by unassigned? Well, the put options need to stay out of the money. They need to have no intrinsic value. And by that, the stock should remain above the strike price, so the holder has no reason to assign. To make the most money selling puts, you'll want to select options with high premiums and lower strike prices compared to the stock's current price. Doing so allows us to profit when the stock's value stays above the strike. Let's say you like Tesla. At the date of this recording, Tesla has underperformed the broad market, but the stock's been doing better. Here, we can take a look at an options chain with an expiration date of about a month from today, which shows tons of information. So here, I'm going to scroll down to puts, and we're going to see a bunch of information. And I'd like you to start by focusing on the premiums. So we want to focus on the last column. Last tells us the last price the option traded for, and it's usually somewhere between the bid and the ask. The bid is what people agree to pay, and the ask is what people or sellers agree to sell the option at. And if you're selling an option, you're usually going to get somewhere between the bid and the ask, or the last traded price. So here we see premiums of 74 cents, $1.04, $1.39, and so on. Whichever put option you decide to select, you'll get the premium times 100 times the number of contracts you decide to sell. So if you select the $115 strike to sell, you'll get $74 per contract in premium. Another thing you'll want to consider are the risks that the put option will be assigned. And for that, we're going to need to look at the delta column. Delta is an options Greek that tells us the amount an options premium will move in relation to a $1 increase in the underlying security's price. So in this case, if Tesla stock moves up by $1, the premium is going to go down by about 4.5 cents. And that's why for put options, the delta is always displayed as a negative number. Because with all things being equal, if the stock goes up by $1, the premium will go down by the amount represented by the delta. But it doesn't end there. If you add 1 to the delta, you'll more or less get the chances that the option is going to expire out of the money. In other words, this option has a 95.5% chance it'll expire out of the money. Don't believe me? Well, let's look at the opposite side of the chain. If we look at the Tesla $210 strike, this is an in-the-money option because the strike price is higher than the stock value. And we see the delta is minus 88.311. In other words, there's only an 11.7% chance that it's going to expire out of the money. So which option would you prefer? An option that has a 95% chance it'll expire worthless? Or 11%? Well, of course we want it to expire worthless. So which is the best strike to select? Well, as a conservative investor, I usually look at selling 20 deltas. In this case, this would be the $140 or $145 strike, as there's an 80% chance that I will get to keep the premium. And give me a like on this video if you'd like an 80 or 85% chance to profit on the trade. And in this case, it would result in about $400 per contract in premium. But you can see here that by volume, that there's an even more aggressive group of investors. See the $150 strike? There were 3,800 contracts sold versus the few hundred for the others. And the $150 strike has an almost 72% chance of expiring out of the money, which is still good, and you'd get paid $600 per contract. But for me, I prefer my 80% chances. It all depends on your risk appetite, and I like to say that I'm not very greedy. Now, delta is great and all, but what if you want to scan for hundreds or thousands of stocks? Well, you can't look at every single one, right? You can't look at all of the chains. So here's a pro tip. Use an options screener to tell you your chances of profitability. Screeners are like a search engine to help you find options that meet your criteria for income and chances of profitability. And once you've got a trade idea, consider each stock's fundamentals and technicals. Remember, selling puts isn't about premium, it's about smart investing. And by the way, I'll leave a link in the description for my favorite stock screener, as well as all of the other options that I use every day to select put options to sell. As you can see, choosing profitable put options involves understanding volatility, selecting an appropriate strike price, considering the expiration date, and of course doing your homework on the stock. It's not a guaranteed win, but by using these steps, it can help tilt the odds in your favor. And remember, nothing in life is guaranteed, well, maybe other than death and taxes. Okay, so before we jump into managing your trades, I want to hear from you. How do you pick your options? Do you have any particular strategies or tools that you swear by? Let's get a conversation going in the comments, because maybe we'll all learn from each other. Maybe it'll be something that I can talk about in a future video. Selling the option is just the beginning, but what do you do afterwards? And how do you ensure that your strategy stays on track? Stick around, because you're not going to want to miss any of these steps. Selling a put option is just the beginning. What comes next is equally important, and that's managing that trade. Let's dive into how you can navigate this phase, ensuring that you're maximizing gains and minimizing risks. First and foremost, keep an eye on the stock's performance. The market is dynamic and things can change quickly. If the stock price approaches the strike price of your put option, well, you're going to need to make a decision. Do you let it ride, hoping that the stock bounces back, or do you take action? Now, one strategy is rolling the option. This means buying back the option you sold and then selling another with a later expiration date. It's kind of like hitting that snooze button, right? You're giving yourself more time for the stock to move in your favor and potentially collecting more premium in the process. But what if the stock dips below your strike price? Well, if you're assigned the shares, remember, this isn't necessarily a loss. Remember, you wanted to buy the stock at the discount. So here's where you can turn to selling covered calls on the stock you now own, generating more income while you wait for the stock to rebound. And here's a video on how you can sell covered calls. Managing your trade also means managing your emotions. Don't let your fear or your greed drive those decisions. Stay disciplined, stick to your plan, and remember why you entered the trade in the first place. Also, it's crucial to keep an eye on market news and events, right? Economic reports, earning reports, indicators, geopolitical events, they can all impact stock prices significantly. And being proactive rather than reactive can make all the difference in options trading. Finally, review and adjust your strategy regularly. What worked for one trade may not work for another. The market is always changing, and so should your approach. So, learning from your trade, whether it's a win or a loss, is the key to becoming a better trader. Now, I'm curious about your experiences. How do you manage your options trades? Do you have any tips or stories to share? Again, drop them in the comments below because sharing is knowledge and it's how we all grow. Now, in the next segment, we're going to be exploring the risks and rewards in more detail. Knowing what you're getting into is crucial for any trader. So stay tuned because this is information you definitely don't want to miss. Trading, especially with options, is a balancing act between risks and rewards. It's crucial to understand both sides to make informed decisions. So let's break down what you need to know. First, let's talk about the rewards, right? Selling put options can be quite lucrative. You can earn premiums up front, which can provide a steady income stream. It's an excellent strategy for generating cash, especially in a flat or slightly bullish market. Plus, there's the potential to buy stocks that you like at a lower price. However, it's not all smooth sailing. The risks are real. The biggest risk in selling put options is being assigned the stock if it falls below the strike price. Now, while this can be part of your strategy, if the stock continues to drop, it can lead to losses. Moreover, selling put options requires capital. It requires money. You need to have the funds or the margin available in your account to cover the purchase of the stock if it's assigned to you. It's a commitment that you need to be prepared for. And as for me, I prefer to keep cash on hand to secure puts. If I get assigned and I'm relying on margin, well, that could spell disaster. And let's not forget about market volatility. High volatility can lead to higher premiums, which is great, but it also means that the market is uncertain, which increases the chance of the stock moving against you. So how do you mitigate those risks? Well, diversification, research, and strategy refinement. Don't put all your eggs in one basket. Spread out your options trades through different stocks and sectors. Stay informed about the companies and the market, and always be ready to adjust your strategy based on market conditions. Remember, every trader has their own risk tolerance and investment goals. It's all about finding that balance that works for you, right? So don't chase those high premiums without considering the potential downside. Smart trading means knowing when to enter the trade and, just as importantly, when to sit one out. I'd love to hear from you how you balance risk and reward in your trading. What strategies have you found effective? Share your thoughts and experience below, because your insights could help fellow traders as well. As we wrap up today's video on how to select put options to sell, I want to leave you with some final thoughts and actionable advice. Whether you're new to options trading or looking to refine your strategies, remember, knowledge is power in the world of investing. First and foremost, education. Never stop learning. The market evolves, new strategies emerge, and regulations change. Stay ahead by reading, attending webinars, and engaging with others. Knowledge isn't just power, it's also profit. Next, practice. Before putting real money on the line, consider using a paper trading account. It's a fantastic way to test strategies, learn from mistakes, and gain confidence without risking your own money. Remember, discipline is the key to your success. Develop a trading plan and stick to it. Define your entry and exit points, set your risk tolerance, and know when to cut your losses. And remember, emotional decisions can be very costly, and discipline, it keeps you focused. And of course, let's not forget about risk management. Consider using stop loss orders, diversify your portfolio, and never invest more than you can afford to lose. Protecting your capital should always be your top priority. And lastly, think about the community. Join forums, subscribe to channels like this one, and engage with other traders. Share your experiences and learn from others and build a network. Trading can be a solitary journey, but you don't have to go at it alone. Selling put options is a powerful strategy, but not without its risks. By following these guidelines and practicing diligently and continuously learning, you can definitely navigate the options market with greater confidence and success. Thank you so much for watching, and I will see you in another video. Bye.